Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's May 30th, and I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Man, really crazy week. Expect to relax a bit after a long holiday weekend. And then I can't believe it. ABC announces that they're canceling Roseanne. What's that about? Making racist comments, getting thrown off the air. What was she thinking? It was actually the biggest story on CNBC on Tuesday. Even though the market fell by 400 points, that was the number one story. But you know what? I want to cover the elephant in the room. I'm getting a lot of questions on. You're seeing it, top story every place. The reason why the market fell by more than 500 points, I think almost 600 points, for coming back a little bit. This is on Tuesday. And that's Italy. And this is the most confusing story ever. Ever. I mean, if you try to really follow this story and what's going on, government, there's no government now. There's another government coming. These guys might do it. Here's just the things. So Italy has something called the Five-Star Movement, which started less than a decade ago. And now it's the largest party in Italian politics. They have about 347 of the 630 seats in Italy's lower house of government. Now, when you look at this party, it's anti-Euro, pro-green, anti-immigration. Like a new leader is just 31 years old. Of this party, Luigi Di Maio. I'm probably pronouncing all this stuff wrong, and I'm going to pronounce a lot of names wrong, but it's not important because you're going to get to the point. At least I will. So I don't want to get too technical here, lose everybody. So I'm just going to give you the quick story here, as quick as I can. So you have the Five-Star Movement. They want to create their own government, along with another party called the League. I know, it sounds like an esports video game, right? That's what it sounds like. So you have these two parties merging together, and they tried to elect a potential finance minister, right? If this does become a government. His name is Paolo Savona. Now, Italy's president, Sergio Mattarella, rejected the appointment of Savona, which is a president he's allowed to do under Italian law, right? He doesn't need the government, doesn't need anything, right? He doesn't, just could do it himself. So this is a big deal, considering the president is using his personal power to block formation of a government that many people in Italy are in favor of, right? And this is a Five-Star Movement combined with the League. This guy Savona is a piece of work, right? That hired for finance minister, Five-Star Movement. He's 81 years old, an economist. He's a little out there, not in a bad way, but you know, he has his agenda, and he's a guy that it's almost you're trying to convince someone to change their religions, right? It's okay, he sees one way, and that's going to be it. So he wrote a book about Italy, how they should have never joined the EU. Italy's purchase power has been halved since joining in the 1990s. He compared Italy to a German cage, I'm quoting him. So the guy's totally against the European Union, which means he's not a market-friendly candidate. And that's why you're seeing the market come down. Because the markets, they don't like uncertainty. And now there is a chance that Italy, if this goes through and they have new elections and you have the Five-Star Movement, the League, if they come into power, we could see something where Italy leaves the European Union. Now, if this happens, we're not looking at something that's Brexit. We're not looking at something, Greece or again, the Greek crisis or something like that. It's a much bigger story because Italy is the third largest economy in Europe behind Germany and France. If this happens, it will be a very big deal. Sure, Italy is a mess, has high debt to GDP. Banking system is very weak. So going through bailouts. Tons of anti-growth laws exist. And the economy is like this for a long time. And you could look back 17 years, guys, where the living standards have not gotten much better in Italy. Okay, this is from doing research, non-biased websites, and even talking to people and some subscribers. People want change. I think about that. If your quality of living for most of the people there has not changed in a long period of time, you want something. Let's try something new. Plus, when you look at the recent bailouts that have come from Italy, and this is about a year ago, it was over 6.6 billion euros needed to be bailed out for one of their troubled banks. And when Italy turned to the ECU, European Central Bank, or ECB, they refused to help out, which is interesting, right? Isn't that the benefit of being in the European Union where, you guys are all together, but they said no, which is kind of like, okay, if you're not going to help us when we need it, and again, Italy hasn't been doing a great job and they've needed a lot of help, then why not just go on our own? So it's a very easy story to tell, even though it'll have huge negative effects, I believe, for Italy, just to break out. Nobody wants to talk about that, right? They just want change. People just want change. They just want change, right? When things aren't good, they want change. They don't care how drastic it's going to be. A good example of that is Donald Trump getting elected, right? They overlooked so many of his flaws and everything and said, listen, we just hate politics. We want to put somebody in there. Again, I know no one in the United States voted for Trump, right? Nobody admits it because I think it means you're a racist and whatever. However, there was, again, he won, 46% of the vote, 45, whatever it was. But that's how extreme it was, right? Where it's kind of like, okay, I'd rather see this than see the status quo because right now we hate the political system. We're not getting anything done. It's the same thing all the time. You guys lie. We have you in social media now, flip-flopping no matter what poll goes on. And let's get someone who's outside and bring them in. So I could see this movement in Italy. Now, if you're still confused about what's going on because of a lot of moving parts, I'll explain to maybe if it's a younger generation who just, hey, I want to know really what's going on. It's a little confusing. If you watch Game of Thrones, this new party, five-star movement, it's kind of like the High Sparrow. So it started as something small, became a huge movement. And I can see that the president of Italy, walk the streets naked. We saw in Game of Thrones with the Queen. Or hold a special meeting in a castle to blow up the entire five-star movement. Again, like we saw in Game of Thrones, we're not going to see stuff like that. But it's basically a party of pissed off people, and they have a right to be pissed since living standards have been terrible for close to 2 decades since Italy joined the EU. Now, what does it mean to you, U.S. investors, or a lot of my people and listeners and subscribers who invest in the U.S. but did not live in the U.S.? As usual, it's a buying opportunity. And we've even seen the markets come back today, but just like we saw with the Greek crisis, it gets overblown. Is it a problem? Of course it's a problem, but we see it coming. This is something in the very early stages. This is almost like the Yankees going 3-10 to begin this season. And you're like, okay, we got to get rid of Aaron Judge. We got to get rid of Stanton. We got to get rid of all the pitchers. The whole team's got to be gutted after the first 10 games. That's where we are with Italy, right? A lot needs to happen for this whole entire thing to really come to fruition where Italy actually, the elections and things like that. It's just going to take a while. And the markets are going to see that coming. We also saw the same thing with Brexit. Massive panics, market crashed, right? Small caps, you could say, is a crash. They fell 20%. But you see Brexit, early 2016. I mean, again, it's something that was overblown. We're okay now. And I mentioned earlier, with the markets falling over 500 points at one time on Tuesday, CNBC's top story was Roseanne getting canceled. Okay, but when you have no more earnings right now, companies like Salesforce reported pretty good earnings, but earnings season is basically over. It's a period where you're not seeing too much. Where companies just before and after earnings season aren't really allowed to talk too much. So we're still in that quiet period of what we talk to. So there's not a lot of news flow going on. So they're going to make these stories 10 times more important than they are. Is this important? It is important, but it's still in the very early stages. And the fact that the markets will adjust and say, okay, what is the worst case scenario? What's going to happen? Here's what we do to adjust. Where companies adjust, if they have sales overseas, wherever it is, this is how they're going to adjust because they're going to see it coming. So looking at the big picture, the chance for Italy to leave the EU is pretty low right now, where a lot has to happen in terms of election, the actual exit could take years. I just mentioned the markets know how to adjust, but when you're looking at our markets, it could influence what the Fed's going to do. So the Fed's supposed to raise rates 3 times this year, right? And now probably another 2 going forward. But the odds after Italy, and this is yesterday, guys, I looked this up. So the odds, which they have odds that they keep for the Fed, possibly raising rates, and that's what they trade off of. But the odds of just one more rate hike from the Fed this year spiked from just 8%, meaning they thought they were going to raise more than one time before Italy, to nearly 50% now. Indicating the market believes the Fed will not raise rates after their next meeting, which is, I believe it's like June 12th, June 13th, around there. Don't quote me on that. So when you look at Italy, it already caused a 10-year to fall. Remember when it hit 3% a few weeks ago and everyone said the world's going to end. That's it. It's over. Recession, contagion, everything, right? Everything's disaster, go buy a cave. Our 10 years at 2.77. Sure, our banks fell on the news, which is Tuesday. Italy's banks also fell, trading at 13-month lows. However, when you look at Italy itself, the 10-year is at 3%. Not insanely crazy. I know it spiked from about 2.3, 2.4% in a short amount of time. But if you want to compare to extreme times, which you would think this is an extreme situation for what we see on CNBC and what we see in Fox and what's being reported in all the papers, the 10-year in Italy was over 8% during the credit crisis. It's just 3% now. So relax. When you look at the whole market, it does create uncertainty. I always tell you, the markets hate uncertainty, almost like with a huge lawsuit going on, like say at Wells Fargo, right, which gets fined pretty much every week. But if you look at stocks, they usually remain weak until a verdict is made. And you'll see a stock actually rise once they're instructed by the courts to pay a certain amount of money, or, that case is over because it removes that uncertainty. So granted, companies, usually know during this lawsuit, they know their max losses if they were to lose, and they keep these cash in reserves. And I'm not saying that a company with $100 million market cap, it does maybe, 30 million sales, gets fined like $2 billion from, whatever, patent infringement for Apple and Samsung at the same time. That stock's not going to go up, obviously. But most of the time when you see that, it's the uncertainty surrounding different settlements, what's going to happen, and you'll see weakness in the stock, and it can't really gain momentum. Once that ends, there's certainty. Here, this is what I'm paying. Here's my fundamentals going forward. Now we can move on. So now in Italy, we have uncertainty, and it's going to be around for a while, but it's in the very, 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 very early stages. There's so much that could happen before then. And right now, the markets are going to adjust and say, okay, what is the worst case scenario? If Italy leaves, what's going to happen to the year? Does the whole thing collapse? I mean, now that you have algorithms pricing in this stuff because it's on the table. And if you notice on Wednesday, we're seeing a nice pop in the markets again, right? It's coming right back. It's almost like we're forcing a risk into this market. And when it happens, just people get nervous and sell stocks. But if you look at the whole economy, if you look at the market out there, there's a lot of positives still. I'm not going to go out there and say stocks are insanely cheap, but they're definitely not super expensive. I don't care what you say. They're not super expensive here based on the current earnings, guys. They're trading about 17 times forward earnings. That's not crazy expensive. And 17 times forward earnings, and you're growing 17, 18%. That's not cheap. I mean, it's not expensive either. That's pretty normal. So you have negative news like tariffs. Apple suppliers cutting production on iPhones. Now to Italian elections, the market's first reaction is to sell off. And when you see this sell off, it triggers algorithms, which are basically a form of front running, right? It's not fundamentals or anything. It's just, they see the orders before them. They're ahead of them. So that caused the market downturn to accelerate, which is what we saw on Tuesday. Now, as an individual investor, which is yourselves, grab a cup of coffee, smoke a joint if that's what you do. Try to relax. Pick out some of your favorite names that are down and scale into them. Don't buy full positions, but scale. I don't know. Maybe the market's come down a little bit further here. Instead of buying, maybe Intel 53, 54, but put a little bit in it. Then if it comes down to 51, put more in it. If it comes down to 49, put more in it. And take a full position into 50. I love Intel. I think Intel's going to be a monster stock for the next 3 to 5 years. It's in our portfolio. We're up well over 20% on it. That's just one example. So again, Italy is not the U.S. And of course, if Italy exits the EU, we will see some negative effects as the rest of the world rushes into treasuries. It's so amazing that treasuries is still the safe haven, not gold, not Bitcoin. Some people still predict the dollar is going to zero. It's going to zero. We're going to lose reserve currency status. Just think of every major event that's negative and where people go to. It's not going anywhere, guys. It's a great story. It's awesome. It sells newsletters. But reality, use your common sense. It won't happen in our lifetimes or in your kids' lifetimes. Anyway, be smart here. Stay calm. We could fall a little bit further, and which I hope, so I could buy some of my favorite names for my personal account, since I do have some dry powder. And when you look at this story, look, I wish I had something more newsworthy for you. Like I don't know, Mussolini's grandson's running for president or something with whatever. Michael Corleone's grandson is a finance minister. Running with Mussolini. Whatever. I'd love to make this so exciting. I just can't. I can't. I do miss the Godfather episodes. They should have stopped after the second one. The third one was horrible. The Vatican, stuff like that. But anyway, you're going to see stories like this overblown. It's normal. It's almost laughable, but it's perfectly fine. Use it to your advantage because it is pushing stocks lower. So be smart. Don't panic. Use a pullback as a buying opportunity. You'd be very, very happy. Trust me. I've been telling you to buy on tariff news when the market came down. I told you to buy on Brexit when the market came down. Why? Because the fundamentals behind the U.S. economy are still great. Very great. Looking at housing, very strong. Looking at just, even if you look at Europe, I mean, where all this is going on, sales are great, right? A steady uptrend. And before this Italy debacle, China sales are also an uptrend. We have strong tax reform, deregulations passed. And who knows if we're going to get an infrastructure bill passed. But it's a strong economy right now. Things are going well. You have unemployment numbers very solid. Inflation a little bit higher, but still modest compared to historically. And in fact, one big positive, I think, that nobody's really talking about is output is surging. So what does that mean, output? There's a strong likelihood that when you see output surge, productivity usually follows. And when that happens, it leads to the very most important indicator that's been lagging, which is wage growth. So we're probably going to see that pretty soon as well. So a lot of positives. I'm not saying, listen, I'm not a perma-bull or a perma-bear. I'm just telling you what the facts are. I don't think this is that big of a deal. Even if it is, you're not going to see it come to fruition for well over a year. But keep it on the radar and use it as a buying opportunity. Now, I have a great interview for you today. My favorite guest is Steve Koomar, editor of the Vigilante newsletter. He's a friend, really amazing analyst. Steve on every few months or so. And the last time he was on, he was also saying you should ignore the headlines around tariffs and buy stocks. Turned out to be a great call. He also said to buy energy stocks. Again, another great call considering oil prices and stocks surged over the past few months. And yes, they pulled back over the past couple of days, which I'll get to in a minute. But he's still up a lot on the recommendations that he's given you through this podcast, which I love because I love to see you guys make money. So today, Steve will talk about politics, including what Italy's elections mean to you, the individual investor. Our potential sit down with North Korea, he's going to go over. So a lot of geopolitical events really quick. Also trade wars with China and Europe. Again, that's coming a little bit in the news now again. But he's going to break a lot of this stuff down and show you why that is this a big deal or isn't a big deal. Also, Steve's going to talk about an amazing trend. It's about to create hyper growth in several sectors. It's a technology trend. He follows technology a lot. And guys, I'm not talking about cloud, AI, or big data, which is pretty cool. Eliminates those. So yes, that's a good tease because I know you're thinking, what could it be? But it's something that's going to enhance all of those. So it's extremely, extremely important. What Steve says, it's one of the biggest industrial revolutions because of this trend that he's seen since the internet. As always, Steve's going to share some of his ideas to play off that trend. And you'll hear from him in just a minute. Later on, in my educational segment, I'm going to break down the current state of the oil market. A sector I've been bullish on for over a year, well ahead of most of the street. Oil prices and stocks went up sharply, but they're pulling back. So before you run out and buy some of your favorite names in the oil patch on this pullback, you better listen to this segment first. Trust me, I'm going to surprise you with some of the information I'm going to give you. And speaking of surprises, let's get to my interview with the one and only Steve Koomar and give a listen to some of his new stocks he suggests you buy today. Steve Koomar, thanks so much for joining us again on the podcast.
Oh, great. Thanks for having me, Frank.
Well, we have a lot of news, right, going on with Italy. And I noticed in your newsletter, Vigilante Investor, you write a lot about geopolitical events and politics. And not so much where your newsletter is pro-Trump or pro-Democrat, but more about the impacts of certain laws, I guess certain geopolitical events will have on your portfolio. And a lot of times you relate back to times in history when this happened. So I wanted to get your take on what you're seeing with Italy, right? We see, new election could be possible, new government being created. People are worried that they may leave the EU, and this would be, further down the line. I covered this earlier in my intro. I wanted to get your thoughts on this because the market did move pretty significantly yesterday on this news, and this news isn't going away anytime soon. Should investors in the U.S. be concerned?
Not really. This is it's very early in the game. If things change significantly in Italy, what has happened so far is really insignificant, and certainly you could move more towards Italy leaving the EU, but that's really not in the picture right now. And if it did happen, ultimately there would be some problems for everybody, only because all these positions are correlated. As people are selling European stocks, they're going to throw the baby out with the bathwater, at least at first. But it's not going to affect the long-term growth picture, particularly in the U.S. So as a U.S. investor, I think you watch it, but I don't think you worry about it.
Now, another topic that you've been writing about a lot, which I loved, and I mentioned last time on the podcast, is tariffs. Still a little bit in the news. I was calling this kind of a non-event, considering that I'm a big believer that when it comes to the EU and it comes to China, they're going to have no choice but to work with us since they have massive surpluses. But what are your thoughts? Because we're seeing stories come back into the market, and it's still there, still some friction, and it is causing a little volatility in the stock market. I want to get your thoughts on this, where some people are worried this could cause inflation, this cause trade wars and things like that. We covered it, but again, it's still in the news, and the market's still kind of like adjusting to this. So what are your thoughts? And I think I talked to you probably about 3 months ago about this, but anything updated now? Is it a concern? Do you see this being more of a concern, or is it more also like a buying opportunity here?
I think in the end, I think it's more of a buying opportunity. However, the threat of a trade war, of really having a real problem somewhere down the road, I don't think it's going to happen. I think, like you said, the EU, China, they don't really have any choice but to play ball right now with the U.S. Those are the countries that are vulnerable, and the U.S. is simply going to extract some concessions in the big picture. But the fact that there is still some concern out there that this could spill into a full-fledged trade war is keeping a lid on the market, and I think that's creating some opportunity to buy stocks, particularly every time that the market dips on some kind of a trade concern. I think those are great times to go out and buy, because this really isn't going to spin out of control. Like I said, Europe and China are going to come to the table. They're going to make concessions. They're not going to like it. They're going to make a lot of noise. But in the end, they're going to make some concessions, and the U.S. is not going to get everything it wants. But it's all going to move forward. And the U.S. is in a really, really good negotiating position. But that doesn't mean that they're going to get everything they want. I think it just means that they're going to be patient about pressing their case, and sometimes they might take incremental gains. And so this is going to kind of continue to come and go. There's going to be an ebb and flow on on the trade concerns and the trade talks. But in the end, I think that every time that you get a dip based on trade, you're supposed to be buying the stocks that you've been waiting to buy.
Now, I want to cover one more geopolitical event, and that's North Korea. When we talked probably 3 months ago, the situation was a lot different than it was now, where, the Olympics and, friends with South Korea now, it seems like meetings are going to go on with the U.S., where the heads of state are going to meet in person. What are your thoughts on this? And I want you to talk, because you've written something pretty amazing in your newsletter that I don't think too many people talk about, with September 3rd, 2017, and North Korea conducted its sixth nuclear weapons test. Talk about that a little bit, because that was a great story, which I don't think people are familiar with, and I'm not reading that anywhere. So if you can, bring that in, because I know it's going to go into your thesis of what's going on with North Korea.
Yes. The last time we talked about North Korea, most of the Western world wasn't aware that in September, the last time that North Korea conducted a nuclear test, it was their sixth test in total, that North Korea blew up several tunnels, caused several tunnels to collapse deep under a mountain where they have their nuclear test site, which isn't that far from the border with China. And there was a collapse at that time, and then there was a secondary collapse in October, and according to Japanese press reports, that secondary collapse killed about 100 rescue workers. So North Korea really, their test site has collapsed. The news of this really kind of leaked out through various Asian media reports last fall, but it wasn't really, people really didn't catch on to what had happened until the Chinese press released this information in late April, just before Kim Jong-un walked across the DMZ in that dramatic meeting, gesture of peace and offer of denuclearization. The day before that, China's media agencies released the information that there was indeed a collapse of this nuclear test site. And so really, there's no way North Korea can afford to rebuild this. And so basically, their nuclear testing is ended. They have a few crude nuclear weapons, but they've never figured out how to miniaturize a weapon that could be put on a missile and delivered somewhere else. And they're not going to get to that point at this. And they've gone ahead, and they have, in the last month, they have completed the collapse of the rest of the tunnels in this test site. But this test site's already radioactive. The Chinese aren't interested in it being used anymore. Probably have told North Korea that they had to stop operations there and start to clean it up. So really, North Korea doesn't have much of a choice at this point in time. They've already started the denuclearization process, and while they at least still have some weapons and there's still some memory of their other recent nuclear tests and missile launches and things like that, they won't find a better time to get good terms for a peace treaty. And so they're looking for a peace treaty, including denuclearization. I think in the end it will lead to a full denuclearization, but time will only tell as to how far that goes. But I think that this is very real. What you're seeing in terms of their need for a peace, they need to re-engage with the global economy. The sanctions have been hurting them badly, and I think China sees this also as a bargaining chip to help them to get a little bit better deal on trade with the U.S. If they can be seen as helping Trump get what he wants on a deal with North Korea, they're much more likely, and Trump has told them that they would get a better deal on trade. And so I think it all fits. This is how North Korea really fits in with the U.S.-China trade negotiations, and I think there's going to be a lot of progress on both fronts in the next month. There's going to be a lot of pressure. There's going to be a lot of noise from all the parties, but everything's lined up for there to be progress. Trump is holding China's feet to the fire on trade. China's going to be holding North Korea's feet to the fire to make a deal, but to not make a deal too quickly because they're going to want to maintain as much negotiating power as they can with the U.S. as well.
No, and I'm glad you explained that. And guys, look, these are geopolitical events that are in the news often. And Steve, when you and I talk, it's not so much that we're talking about this stuff where it's more like different ideas and maybe different sectors, but this is being mentioned in the news, CNBC, and you hear these stories all the time. So, it kind of forced us to write about them and say, hey, guys, look, it's not that big of a deal. We'll let you know when it's a big deal. And this comes back to everything, right? Because you're one of the analysts, I want to say contrarian, actually, because you're long-term bullish, right? Since people who talk about being bullish, or the people I talk to are bullish, everyone says the same thing. The market's good, but, which, everything before but's kind of meaningless, right? But they say, but the market could really fall due to deficits later on, right? So it's the next 2 years are going to be good. You never really have people come on and say, listen, the next 10 years look fantastic. And that's what you're saying here, where you like stocks, you think there's a lot of things in place today. Could you talk about that sentiment? Because we're hearing so many bearish stories out there and only short-term bullish. But you're saying, listen, this is a market to earn or to generate significant returns over the next decade.
Yes. The policy-related stimulus for the U.S. economy over the next decade is really something that we haven't seen in 70, 80 years. In particular with this, we've seen a corporate tax cut, and we've seen that tax cut includes specific incentives for investment in plant and equipment and that sort of thing, capital investment, where you can immediately write off those investments. those things are going to increase investment by corporations significantly, having a lower hurdle rate, a lower tax rate, as well as a tax incentive to invest immediately. In addition to that, the reduction in regulation is going to improve profitability going forward and reduce uncertainty as well. And so that program of tax incentives, lower tax rates, and deregulation is going to increase investment in the U.S. for a long time. And it's going to take many, many years for this to play out, more than a decade for it to play out. And what you're going to see is increasing rates of productivity, which is going to reduce inflationary pressures, even as wages rise and probably rise significantly. Because if you go from 1% rate of productivity growth to 2 or 3%, which is what Japan has right now, you're going to see much higher growth rates and lower unit labor costs, because as workers produce more out of every hour that they work, then the actual cost to employ them, even if you raise their wages, isn't going to rise that much. It might even go down. So all the way around, you're kind of developing this virtuous circle where you're going to get increasing rates of growth, increasing rates of consumption from the labor force, which is going to be getting paid more and more, and it will lead to a stronger economy and stronger investment returns. And an important thing is, if you're getting higher wages but you're not getting significantly higher wage inflation, the Fed can keep rates relatively low for a long time. And the last time we were in a phase like this was in the 40s and 50s, when we had some of the New Deal reforms were implemented that really brought a lot of new capital investment into the marketplace. And you had a similar thing where the Fed kept rates essentially below 2% until from 1929 until 1957. And you had a couple of wars in there. You had some years where economic growth was over 10%. There were a lot of reasons why you might have gotten sustained inflation, but you didn't, even as wages rose. And it's because productivity growth was very, very high as that investment cycle played out. And we're in another period like that right now, and this is going to go on for a while. The rest of the world doesn't have this same kind of policy boost to investment, policy-related boost to investment. And so I think that you're going to see the U.S. outperform a lot of these other countries. I mean, I think that they're in the developing world, there's still some great stories out there, like India and Mexico. They've got such great demographics and reforms going on in their economy, where there's probably going to be really great returns in some of these other countries that still outpaces the U.S. But the rates of growth in this in the economy and in the stock market in the U.S. is still going to be above trend for the next decade. It's going to be very good.
Now, Steve, I want to ask you, what are some of the risks to that thesis? Because what we hear out there, and I know you're an analyst, so this is what you'll look at, right? We all look at things and come up with predictions, but we also highlight our risks as well, right? Because there's always a possibility we could be wrong, and everybody's wrong sometimes in their career. Do you see where the Fed maybe could aggressively raise rates too high because we're seeing maybe I don't know. Maybe we have runaway inflation. You're seeing deficits where, yes, we have tax cuts, but, in order to have those tax cuts, we have to take obviously the deficit's going to be higher, but we're hoping to make that up with, higher growth, GDP and stuff like that. But if we don't see that, what are some of the things or the risks that you see? Or maybe, after Trump doesn't get elected, is it a possibility that these tax cuts get reversed at all? Is there anything that you see on the horizon like that could have you worried?
Yeah, so I guess we can break this down into policy-related risks, two different kinds of policy-related risks. The fiscal policy or the tax policies, could that change? And could Fed policy on monetary policy, could that upset the apple cart? And I think that what you'd have to get, you're going to get political change that's going to cause fiscal policy to change. It's always going to happen. There's an ebb and flow to the power, the control of every party out there. However, if the policies are working, the party that takes over doesn't reverse them. It never happens, especially during these periods of revolutionary change like you had with the New Deal, and you had several other times going back to when Hamilton and Jefferson were fighting with each other over monetary reforms in the U.S. in the 1790s. Every time you've had new policies that took effect that were working, that were making people's lives better, that were making the economy perform, the new party that came into power didn't reverse the policy change. They embraced them and kept them. I mean, Hamilton and Jefferson fought like dogs. When Jefferson finally won that fight, and he wanted to expand the country and take on the Louisiana Purchase, he desperately needed the monetary reforms that Hamilton had created in order to have the tax revenue to do what he needed to do. So he didn't change anything. He didn't reverse anything, and he took his revolution in a different direction. But he did it by embracing the important monetary reforms. And the New Deal, the Republicans, whenever they took power in the 50s and in the 80s, they didn't reverse any of the New Deal. They kept it. They embraced it. And in fact, sometimes they increased their own put their own regulations on top of what was already there. And Sarbanes-Oxley was kind of an excessive act of regulation that was really implemented by Republicans. So I think in this case, you're going to get times when the Democrats are going to be in power and the Republicans are going to be in power. But this tax cut is having such a positive impact on the economy and on growth. And even though, some of the leaders out there, like I think Nancy Pelosi still talks about reversing some of these tax cuts, or at times, I think that they're just not going to have the guts to reverse it. It would be too hard to do when things are going so well, and it would probably mean that they would lose power very quickly when they saw how the economy turned down. So I just don't think that there's much of a chance of that. It could happen, but I think it's unlikely. The other part of that would be the monetary policy and how much that could upset things. And could the Fed raise rates so fast that it kills the economy? And I expect that to happen at some point, probably in the next couple of years. I think that the Fed has been talking like they're willing to be patient about inflation and allow inflation to overshoot a little bit, and that's good news. And it might mean that they're a little slower to raise rates too fast, but that's just a cyclical risk. Even if they do raise rates too fast and create a recession, the Fed will respond by cutting rates very significantly, and they will it won't. If you don't reverse the fiscal incentives, you'll still see the long-term growth rate of the economy and of the stock market accelerate above normal, even as you do get little recessions here and there that could slow the progress. So yeah, I think that I'm less worried about the monetary policy risk, but I think that's something that investors should be on guard if the Fed starts to raise rates very quickly. Much more. Right now, I think they're forecasting getting to 3.5% area in 2020. If they really do that, I think if they get to that rate that fast, I think there is a good chance that we end up with a recession. But I think it would be a temporary setback.
Yeah, and you're looking long term here, which is great. And guys, look, we're talking about the economy, we're talking about Fed policies, we're talking about geopolitical risks. Again, it's all fitting into this, which I know you love, which is the stock picks and sectors. And one of the sectors that you're high on, and I know you follow technology a lot, and people talk about AI and IoT and big data analytics and cloud. We hear this term all the time, but it was pretty far away. Now it seems like it's right around the corner. But 5G is something that you've been looking at. Could you explain what 5G is? From what I know, and again, I went to the Consumer Electronics Show every year for the past 7 years, guys. This year, the biggest theme was probably 5G, and it came from Qualcomm, it came from Intel, it came from Broadcom, Ericsson, right? So those are like the four companies. I know you have the AT&Ts and Verizon, but that's what I see. And I know China, there's stories out there that China is really killing us in this, and they're first to the market here. But this is what I'm reading. Let's talk to someone like yourself who's followed this industry. Talk about 5G and maybe some of the players, some of the stocks that you like here.
Well, 5G is every generation of cellular technology, starting with, I guess it would be 1G, which came in 1983, has created a revolution in mobile communications. But 5G is just going to be such an exponential change and improvement that what you're going to get from mobile will be, faster and better than what most people already get from fixed internet service right now. And it's going to enable just an incredible change in terms of the industrial application and connectivity of everything that we do. What 5G is going to do is basically it's a new standard or a set of standards. It's going to bring multiple additional technologies into creating more capacity and more speed in mobile cellular communications. So there's going to be it's going to be like something like 1,000 times more capacity in the system. 4G increased data speeds by a factor of 10 times. 5G will increase data speeds somewhere between 10 times and 100 times what 4G is. So the exponential growth is going to be amazing. What you got with 4G was a lot of media applications, and people can walk around and engage with the media on their cell phones pretty much anywhere. But this 5G with the really, really super fast speeds and very low latency and universal coverage, it's going to allow industrial applications in very remote areas, in rural areas even. And when I say that, I mean, I think if we ever get to the point where we have truly autonomous vehicles, it's going to be through 5G technology that's going to enable that to happen, because when you have almost no latency, and by latency I mean no delays in the communication back and forth from a remote device, almost no latency, and everything is immediate, the car will be able to have all kinds of chips, the communication chips that communicate via the cloud. And basically, instead of having a whole bunch of computers inside the car that's trying to automate the driving of the car, there will be some devices on the cloud that are directing the car, and it will just be there will be so much more that you'll be able to get into that car, and it will be a lot less expensive. And so, if you're ever going to get to a reality of automated driving, this is the critical tool, is 5G. It's just going to make the communication so much better. But everything in the IoT, Internet of Things, artificial intelligence, and industrial applications, it's kind of like it's limitless. The possibilities are just limitless, and we can't even imagine all the ways in which this is going to happen and how it's going to play out. I think, for me right now, I mean, I think that there's going to be long-term some big winners in the cloud area. I think there already are. There's already a lot of anticipation of this in the market in some of these cloud stocks. I think it's a lot of what's behind Amazon's success, actually, and its returns. Microsoft, you name it. I mean, these companies are big in the cloud, are doing very well, and I think it's not all their Amazon's retailing business. It's not all of Microsoft's their subscription services. A lot of it is people looking ahead to how the cloud and 5G is going to work out for them. But I think that, when you go back to this is going to be an enormous boom, and it's kind of like a gold rush thing. And you go back to the gold rush, 1850s, the big winners were the sellers of picks and shovels, not the producers of gold. And I think that, some of the people that put together the infrastructure that make the infrastructure equipment, the big radios and that sort of thing. The companies like Qualcomm that produce the chips that go into devices, those companies are going to do very well. The companies that actually design and construct the actual infrastructure, the towers, and actually install all this new equipment that's going to go in. Those companies are going to do very, very well. They're going to build enormous backlogs as this gets built out. I think that there's going to be some geographic differences in terms of how this plays out. It seems like the U.S. and China and Korea are ahead of everyone else on it, likely to be implemented in 2019. I think everybody else is really not that far behind, but there will be some advantage to the countries that start early, because all of their companies that are domiciled there are going to be able to start developing their applications earlier and sell them all around the world.
Now, it's interesting that you say when it comes to towers, when it comes to building this stuff, because what we saw with Apple, which is a good example, guys, is when Apple's growth slows, right? And they're saying that they're not going to sell as many iPhones, and they're warning, and you're seeing companies like Taiwan Semiconductor, lower their estimates and saying it's due to slower smartphone sales, right? Which means the iPhone's the largest seller, and also when you have Samsung as well. Both customers, right, of Taiwan Semi, they're basically saying the future, right? They're talking about the future. So when Apple reports earnings, they report earnings over the past 3 months. And where I'm getting to is Steve, 5G is not really here in the U.S. yet, where they're implementing it, you're hearing about it, and you're seeing it. But in terms of being a big benefit to consumers, it's still a little ways off, I think, right? It's almost here, but the infrastructure needs to be built, and that's where. And I don't want to put words in your mouth, but is this the place you're looking now? Because not only these parts and the nuts and bolts plays, do fantastic during this trend. It's like when we say nuts and bolts, like you said, it's the people who make the parts that go into the iPhone, which is, whatever, dozens and dozens of parts. But when you look at this is that the best play? Because it seems like they're going to, we have to build more towers now. These chips need to be built now, right? So is that the better play than going with some of the bigger players that are going to benefit from this, or maybe the Verizons and the AT&Ts?
Verizon and AT&T are going to be interesting cases, because they're going to have to spend a lot of money, right, to roll this out, and T-Mobile is going to be doing it as well, and Sprint, but Verizon and AT&T also have fixed broadband services, and to some extent, some of these fixed broadband services are going to get cannibalized by the mobile. Particularly in suburban and rural areas, the mobile is going to probably in many cases deliver a better service at a cheaper price. So I don't really know how to evaluate right now Verizon and AT&T and how that's going to work. I think it could be great for them, and it could be that it's a mixed bag. I really don't know. I know that there's a lot of investment they're going to have to make to get to where they want to be, and they're definitely doing it. I worry a little bit about a company like Comcast that isn't going to have, unless they buy somebody like T-Mobile, they're not going to have the mobile broadband, and they don't. Their fixed services are, I think that they're kind of like, you got to buy them now. But if you have a competitor out there in mobile that could deliver you better service at a lower price, they might have a hard time. I think that might be part of the reason why they're morphing into really more of a media company right now, and they want to buy Fox and do all this kind of stuff. It's going to be interesting to see how the big telecommunication players, how things work out for them going forward. But the guys that are building the infrastructure for AT&T, there's one of those companies I've got in my portfolio right now, that's Mastech. And they've grown significantly in the last 2 years on developing oil infrastructure, oil pipelines, and the like. But they've got a bigger business in telecommunications, and they are AT&T's primary contractor. And AT&T is going to spend a whole lot of money on 5G, and Mastech's going to build an enormous backlog of contracts in order to do that, on top of what they're already doing in oil and gas infrastructure. So, like, that would be, to me, right there. I mean, I would say that would be one of my favorite plays. It's already in my portfolio. I've got it from a much lower price, but I think I think we bought it a year and a half ago at about $34 a share. It's 47, 48 now. Arguably, it's cheaper now than it was then. So I think that's a really good buy for people right now.
Yeah, and for people that don't understand that and say, well, it's higher, how is it cheaper? It's all about earnings. So, I mean, if you're basically earning more money now than you were then, or your earnings increase by 200% and your stock price is up 30%, it's going to be cheaper now, even though the stock price is higher. And sometimes people say, how can it be that cheaper? It was, at a lower price. But again, you want to look at earnings, and that's what fuels growth. But listen, Steve, great stuff on 5G. And guys, when you're researching this trend, just understand when we talk about IoT, when you talk about big data analytics, and you can come in here if you want, Steve, but when we talk about cloud, what 5G is going to do is enhance these trends and make them that much better, which provide more speed, more ways you can analyze stuff, more capabilities. So this is why it seems like it's such a priority right now. But it's funny because when you said, hey, I'd like to talk about 5G, it's something that gets lost where we're like, oh, 5G. But in reality, this is a monster trend because this is going to relate to IoT. All the major trends that you see, this is going to enhance them. So you could see the focus and the spending coming up on them. And I don't know if that's the way you would describe it, but it is very interesting and fascinating because when we talked and you said you wanted to talk about this trend, I started doing a lot of more research on it. And it is pretty exciting. And there are a lot of players and there's still money to be made from what I see.
Yeah, it's the biggest thing. It's the biggest industrial development that's happened I think since the internet. And because it just takes it to just an incredible different level. And so, yeah, and in my next issue, I'm going to be focusing on 5G. That's really what my next issue is about. Maybe my next 2 or 3. I mean, I think it's that big. It's that important that you really, to get your hands around all the things that it's going to affect is important. And it's something that we can guess some of the early stage developments. Like I can say that somebody that's going to build out the infrastructure is going to do really well. But in the long run, the way it's going to change the competitive environment is going to be very dynamic and not entirely easy to predict right now.
No, it's great stuff. Looking forward to reading your issue, Vigilante Investor, coming out, guys. If you want access to that, Steve, how do they go? Can you give them the website or a way they can contact you?
My website is vigilanteinvestor.com. And you can also follow me on Twitter at VI Investor. And if you'd like, contact me, ask me questions. I'll be glad to help you out the best I can.
That's awesome. It's amazing, right? Because when we were first doing this and we first talked, just starting the newsletter. I don't think you had a Twitter account. Now you're giving out your Twitter handle, and I think things that come along pretty good. Huh? It's starting to like this industry a little bit, I think.
Oh yeah, it's a lot of fun. I really enjoy it, and it's a great thing. I like to write. I like to analyze, and I like to enlighten people on what I figure out, what I learn. But I learn just as much from subscribers and others that write back to me and point things out. And I love the back and forth. It's great.
It really is great. So, Steve, listen, I love when you come on. So do my guests, because you're always there to give us picks and talk about the industry and the markets. And I know everyone subscribed to your newsletter, loves it, loves your research. I love reading it. I learn something new all the time. So I really appreciate you coming on the show, bud.
Well, thanks, Frank. It's my pleasure. Look forward to doing it again sometime.
All right, guys, great stuff from Steve. I love when people have strong opinions. I'm not hearing that, hey, the market's going to be great over the next decade. And yeah, well, we've heard that from Buffett. He said that. But pretty much he's been bullish on the market for the last 30 years, and no one really pays attention to that, even though he says America's in great shape. But when you see an analyst come on and say that, what you want to hear, because that's not necessarily my opinion, right? I'm not bringing on guys that support my opinion. I'd rather that they have different opinions. Me, I'm cautiously bullish and believe that, hey, I'm looking out 2 years, which is as far as I could see. But he's right. And what I love about Steve is it's not whether you agree with him or not, because I know a lot of you are cautious out there and you should be, but you want an analyst to come on here and support his thesis. And he does that. He's talking about tax reforms, infrastructure, why things are so different now, why the landscape is different. And this is someone who's a 20-year plus analyst, been in this industry. really, if you look at his newsletter, Vigilante Investor, he's going to tell you a lot of things and compare this time to historical times. And he goes back to the 50s, the 40s, the 30s, the 20s. It says, listen, last time Fed did this or did this, this is what happened. And he proves his point, which is cool because it makes you think. It doesn't mean you have to agree with it. People think Bitcoin's going to 100, a million. Let's see the stats behind it. It's that because if it goes to just 50,000 Bitcoin, it's going to be bigger than Apple, right? So a million is kind of like, okay, why don't you explain that? So I hear people say Bitcoin's going to a million. I never heard anyone or saw that model behind it or explain a thesis of how that's going to happen, which is fine, which you see a lot in this world, right? People just make calls and there's no credibility. They don't care. With Steve or with any of my guests, no matter what they say right away, even if you have a different opinion, listen. That's where you educate yourself because you could disagree and say, you know what, I don't agree with that. I think the Fed is going to do stupid things. They're going to raise much faster than expected. Inflation is going to be out of control. Deficit is going to be out of control. And the markets are going to come down. That's fine. But listen to other people's opinions, even if you don't agree, and see where they're wrong because they might change your mind on certain things. In the end, it's going to make you a better investor. So I think he did a great job explaining why he believes stocks are going to go higher over the next decade. Steve's a good friend. He writes a great newsletter, again, Vigilante Investor. If you have any questions, I always say this podcast is more about you than me. So if you guys do have any questions, feel free to email me at frank@CurzioResearch.com. That's frank@CurzioResearch.com. I mean, your thoughts about the interviews, people, guests you want on the show and stuff like that, whatever. Anyway, let's move on. I don't want to run too late here. I want to get to my educational segment, which is on oil. As you know, I follow oil for a very long time, have great contacts in this industry where I was able to visit all the major shale areas in the United States, learn about this stuff, this technology years before anybody else when it comes to shale oil. My subscribers did very well and profited from that. And people who've listened to this podcast, at least you've been listening for a very long time. We'll talk about 2009, 2010, 2011, around that time frame. Yes, I've been doing a podcast that long and I'm getting old. But oil is an industry that I love. I feel like it's one of the industries that I can really gauge and have a good outlook on it. Not necessarily all the times with stock picks, but where the market is heading. I remember I was invited. This is after I was at Stansberry. The next year I was at Weiss, and I was invited to Stansberry conference. I think it was 2015 to talk about oil. And I said, how many people have an oil stock in their portfolio? 95% of the audience, I think it was close to 600-700 people there, raised their hand. I said, you should sell every single oil stock in your portfolio right now. And everybody thought I was crazy until they saw my presentation, which showed that the reason why oil is going to collapse even further and a lot of these companies are going to go out of business because they're oil hedged right now. And those hedges are coming off. So when oil started collapsing from 100 to 70, a lot of these guys were still making money because they were hedging 80, 85, $9 a barrel. Once those hedges came off, oil price started going to 60, 50, 40. Now, if you want to lock in prices, you got to do it at a much lower price, which doesn't make sense because most of these guys can't produce for under $4 a barrel. Yes, in the Permian, there's four counties inside the Permian, not the whole Permian, where some people would say, yes, we can produce for less than $30 a barrel. And I have a stock like that in our portfolio. And Curzio Venture Opportunities is up 100%. Recommended that pretty much, I want to say 9 months ago, maybe a little bit longer. It's an amazing company. But most people can't. So what happens when we see oil at 40? Because this is a year ago when we were at $40 and it just came up off of what? I think it went below 30 really quick. And we're looking at oil at 40 and everyone's saying, well, this is temporary. There's still a ton of supply in the market. And I was very bullish. And I said, hey, guys, listen, pedal to the metal here. Oil is going to go a lot higher because when we see it go to under 40, especially 30, what happens? A ton of production in America comes offline, millions and millions of barrels, and it happens very quickly. So they cannot produce at that level. So it could fall further and further. That's fine. But eventually, prices are going to have to come back up. So at 40, I was very bullish. Reiterated that bullish thesis for a very long time. Over the last year, right? And when I was recommending that I was going to go higher, at that time, guys, it was interesting because when it was at 40, I would say 80%, 85% of the sentiment was negative, and people were saying it's going to 30, it's going to 20. There was some people saying that oil was going to 10. That's what I love to see. When you see strong sentiment on the opposite, that means you're a contrarian, and it worked out. Where am I going with this? Oil prices are now 70. The whole world is completely bullish on oil, right? And we're seeing oil come down. Why? Because Russia and OPEC met and said, listen, you know what? We're thinking about increasing our output, right? They cut output, and they reiterated that stance in 2017 and said, all right, we're going to keep those barrels off the market to inflate prices. So now they met, and there's rumors this 2 days ago that, hey, you know what? They might increase their output by 1 million barrels. And I'm going to tell you something, okay? Because this is important to understand about the oil industry. So if you're looking at OPEC, OPEC stands for the Organization of the Petroleum Exporting Countries. So there's an agency that consists of 13 oil-producing countries, right, mostly in the Middle East, whose mission is to ensure the stabilization of oil prices. At least that's what they're defined to do. So we had November 2016, OPEC decided to cut supply by 1.2 million barrels. It was the first time the cartel cut supplies since the credit crisis, 2009. OPEC decided to initiate these cuts to help prop up oil prices, right? It had a big effect because oil prices surged by 20% to over $50 a barrel in less than a month. Okay, we're looking at December 2016 here. So now you look at 2017, pretty much held strong. And then March, April, they came down to a little bit below 50, but now they've actually pushed up a lot higher. So when you look at OPEC cutting supplies, they've reiterated this stance and everything is cool. But if you're worried about Russia and OPEC increasing their output, I'm just going to tell you something. Okay, it's a very important story. This way you understand oil, guys. So in late 2014, OPEC made the worst move its organization was founded since 1960 by far. Okay, this is 2014. So oil prices were averaging over $90 a barrel for several years, right? We're getting used to $100 a barrel oil price. It wasn't a problem. Everything was cool. America was on the verge of becoming the biggest oil producer in the world, right? This is 2014 because unconventional production, fracking, extremely profitable at current prices, and they were going crazy. So OPEC, in an effort to disrupt the U.S. shale industry, decided to suspend quotas and let their OPEC members produce oil at whatever rate they wanted. Say, go crazy, guys. Go nuts. Let's have some fun. So the goal was to lower oil prices enough, $50, $40, maybe even $60 at that time, so that shale production in the U.S. was uneconomical. And this will help OPEC regain that market share over the long term. The move completely backfired. So if you're looking at OPEC, they already supplied 40% of the world's oil. That was back then. Saudi Arabia increased their production by 11% in less than a month after this decision. Iran, Libya also raised production significantly, resulted in millions of barrels of oil flooding the market. In the meantime, you're looking at GDP in developed nations like Germany, Canada, Germany at the time, Switzerland. They slowed considerably, right? Around 1%. You have emerging markets, China, Brazil, Russia also slowed much more than what economists were predicting. In 2015, 2016, it was the worst time to do this. So what happened? That massive oil production coupled with slowing demand created the perfect storm. That explains why the price of oil crashed 70% after OPEC removed its quotas, and this was late 2014. I'm going to tell you how much that amounts to, and think about this for a second. Because this is numbers from the OPEC's Director General. That move cost the cartel $2 trillion during that oil crash. Okay? To put that in perspective, Enron lost $74 million. That was their loss, $74 million for Enron, right? Which started everything, the fiasco and stuff. $2 trillion. So for those of you who think that OPEC and Russia are going to drastically increase production, they're going to kill themselves. They're going to crush themselves. So what does this mean? Should you go out and buy oil? Not necessarily. Because I said earlier, when it comes to sentiment, when I was bullish on oil at $40, saying it's going to go higher, because we knew, based on the statistics, when it goes below 40, we see tons of production come offline. In the U.S., that production can come back online within 2 weeks. That's all it takes to turn those forces back on. And if you're looking at the U.S. right now, you're seeing production starting to skyrocket. So we're going to see more supply on the market. I don't think the story is, hey, you're going to see more oil flood the markets from every place outside the U.S., from OPEC, from Russia. I don't think they're crazy enough to do that unless they hate money. But when it comes to the U.S., right now where prices are, and you're seeing the price go over 70, this is WTI, and come back down now, it's around 66, 67, which people like. This is a massive decline. Guys, it just went from 40 to 70 recently. It's not a massive decline. It's just a minor pullback. But the fact is, when I look at sentiment right now, and you're seeing more production come online for the U.S. shale producers, and not only that, they can lock in prices here. Now, who locks in prices? Well, they're called hedges. I mean, what kind of companies hedge? Well, think of transportation companies. When you're looking at Walmart, if you're looking at FedEx, UPS, Target, airlines, If you look between 2015 and 2017, companies generated $23 billion in gains from hedging. Okay, that's according to Wood Mackenzie. Today, you have Laredo, a company called Parsley Energy. They have 90% of the production hedged because they're hedging now because they know they can make money. And remember, these companies, although they were much more leveraged, they're still leveraged. They just pushed their debt out a few years. So you still have significant debt. They just don't have as much debt due over the next 2 years compared to over the next 5. So the fact that they could lock in a price right now and be profitable, most of these guys are going to do it with the current state of their balance sheet. What does that mean? That means even if oil does come down a little more, you're going to see American companies continue to flood the market. That's one of the negatives here. Another negative is sentiment. When it was 40, we heard $10 oil, $20 oil. How many forecasts are we hearing of $100 oil right now? A lot different, right? You always hear these crazy forecasts at the highs and the crazy, crazy low forecasts at the lows. So now sentiment has shifted from super bearish to super bullish. And this is Bank of America predicting $100 forecast. So you're looking at traders in the option market. I mean, December 2018, the 100 calls. You're looking at large oil funds. I mean, a lot of these guys see $100 oil. And when it comes to oil, the biggest thing, if you forget Russia, forget OPEC, forget U.S. shale production, forget everything. When it comes to oil, if you're looking to gauge short-term movements, go by sentiment. It works almost every time. If everybody's bullish, it's going to come down. If everybody's bearish, it's going to go higher. It's crazy. It works like that. You can go back. At 40, everybody was bearish. They got a lot of negative emails. Right now, everybody's really bullish. We benefited on some of our oil picks, doing pretty well. It was a great call. However, we may look to take profits because I do see a little more weakness in the oil industry as prices come down. One, because you're going to see tons of oil hit the market as hedges are in place now. These guys are going to be producing, which means, again, why do people hedge? Well, if you look at fuel costs, guys, when it comes to airlines, oil is an extremely volatile commodity. Now you're looking and say, hey, I have all these growth plans, everything I'm going to do over the next year or two. This is what we're going to do. We're going to add a fleet. We're going to add, 50 planes and more routes and all this stuff, and things are great and hire more people. If you're not hedged and oil prices go to like $120 a barrel, forget about those plans. You got to scrap them. But when you hedge, you're locking in the price and allows you to look at your company and say, okay, it provides, just that extra layer of security, that extra layer that you could see and say, hey, you know what, the market, I could see what's coming down the line. We don't have any disruptions. We could actually forecast correctly where we don't have to worry about the price of a certain commodity go higher or lower, which is a major cost to our business. So you want to lock in that price, at least lock in some of the production, 70, 80% or whatever. This way your costs are fixed. It's a lot easier to project what you're going to do and have all these plans set for your company and forecast when you have those prices fixed. So right now you have a lot of these oil companies that are locking in prices over the next year. Some of them, EOG is one of the largest. They have less than 10% of their production hedged. But when you're looking at these companies right now, what does that mean? If oil keeps going lower and lower, say if it goes to 50, these guys are still going to be pedal to the metal producing because they locked in their prices. 70, 80% of their production is hedged. They're going to keep producing. So even when oil prices come down, you have to wait. That's what I might call in 2015. It was, hey, these hedges are coming off. Yeah, oil price went from 100 to 70 and some of these stocks have fallen, but you haven't seen nothing yet. So when these hedges come off, these guys have tons of debt due over the next 3 years, and now they can't make money producing the only thing that they produce, the only thing that they make, which is oil. They can't do it economically. So they're in trouble, and that's why we saw so many bankruptcies. But even a bigger game changer is sentiment. I mean, you're looking at $100 oil price. Where was that? People say, we're never going to see 100. The days of $100 oil price are gone. We'll never see it again. Now, a few months later, we go from 40 to 70. Now we're seeing, hey, $100 barrel by next year. That tells you prices are probably going to come down. That means you're going to see some of these stocks, their prices come down. Look at the hedges. See where they're hedged. A lot of these guys disclose that in their presentations on their website. Go directly there to their presentations. Which means if these stocks come down, they're still going to see pretty strong profits over the next couple of quarters, and it could be a buying opportunity. But be smart about the names you buy because oil prices are probably going to come down a little bit. I see them testing the $60 level pretty much over the next 3 to 4 months. Let's see if I'm right. I'll revisit this thesis, but be very, very careful. Someone that's been bullish on oil has been right within oil. Again, I talk about my losers all the time. This is one of the sectors that I feel like I have a grasp on that I know very well and able to predict. I see oil prices coming down a little bit further in the short term, and it'll probably create some good buying opportunities if you pick the right stocks. And to find those stocks, I can't give those away for free as well. but you'll see a lot of those names come out in my newsletter. Okay, guys, be sure to check your emails since we're launching Crypto Intelligence in just a few weeks. I'm really excited. So much to get this project together. You're probably already receiving emails about our free educational segments. Also, how you can ask Barry Cohen, who's the editor of this product, some questions about cryptos, anything you want, how to invest in these things, exchange to uses. The early interest has been off the chart so far, and it should be. Because right now, it's a great time. I mean, you're seeing cryptocurrencies, Bitcoin, a lot of them have come down. And Barry's really excited. And we see more regulation coming into this market, which is going to be a boom to the industry. That might sound crazy and say, well, more regulation, I don't get it. Well, just think like the SEC and the laws surrounding investments. I mean, those are pretty great for America following the Great Depression. If you look at the market, it's been straight up since then. So I'm not talking about over-regulation, but just putting rules in place to protect investors. Since I know so many of you want to get into this market, and it is dangerous. So it's very speculative. However, we've seen life-changing returns in some of these tokens, some up 10,000% or more in months. Still the very early innings of this industry where Barry's going to introduce you some of the really cool ICOs. And believe me, he doesn't like, I think he says 90% of them are crap. And I've seen some of these things in a white paper. Guys are like, this is what we're going to do, all this stuff. Give me $20 million. And it's really like on the paper napkin. No assets, no nothing. It's crazy. But you need someone to tell you, hey, this is garbage, but this one's really good and can be a big difference. And that's what Barry's did. That's why he's been out there for the last 7-8 months attending all these conferences, meeting top execs. Great. It's been awesome. Not only that, he's going to share his favorite investment with new subscribers, a token he believes has a good chance, I'm not kidding here, obviously I know the recommendation, of replacing Bitcoin as a standard in the industry. And he's not alone with this sentiment. It's not something where he's on an island. I mean, several of the biggest names in the industry are also talking about this amazing company. And it's literally trading at less than 1/100th of Bitcoin right now. And that's going to be an investor he's going to talk a lot about. And it's really, really fantastic. Something that has me excited. So if you want to get on a mailing list, learn more about this product, cryptocurrencies, you can do so by going to CurzioResearch.com. If you're in on a list, again, you're getting a lot of free stuff. Education is what we want to do. It doesn't mean you have to buy the newsletter, but, you know, if it's something you're interested in after that free educational series and everything that we're doing and you know, having access directly to Barry where he's going to answer some of your questions, we're going to come up with a fantastic offer. But be sure to check your emails because we're launching this in about 2 weeks. Again, very, very excited. Crypto Intelligence. And if you guys have any questions, Frank at CurzioResearch.com. Again, you're always here to answer your emails and questions. So again, very excited for this product launch, and you're going to be getting emails about it over the next couple of weeks. Not that you have to subscribe again. If you want to, you can. It doesn't matter. But it's going to be really cool stuff, and we're going to send out stories about cryptos and different things probably that you never heard of that's fascinating about this industry. So it's going to be really, really cool. So guys, that's it for me. Thanks so much for listening. I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.